Are you ready to learn the secrets of one of the most successful investors in history? Join us as we dive into the wisdom of Peter Lynch, the Wall Street legend who averaged a 29% annual return during his 13-year tenure as the manager of the Fidelity Magellan Fund. From identifying undervalued companies to understanding the psychology of the market, we'll uncover the strategies and insights that made Lynch a master of the investment game. So sit back, grab a notebook, and get ready to learn from the best as we uncover the wisdom of Peter Lynch. Peter Lynch is widely considered one of the greatest investors of all time. During his 13-year tenure as the manager of the Fidelity Magellan Fund, Lynch averaged a 29% annual return, turning an $18 million fund into a $14 billion powerhouse. But Lynch's success wasn't just a matter of luck or a hot hand, it was the result of a unique and disciplined investment approach that emphasized a deep understanding of individual companies and industries, as well as the psychology of the market. In this video, we'll explore some of the key principles and strategies that Lynch used to achieve such remarkable success, and show how they can be applied to your own investment decisions. Number 1. Buy what you know. One of Lynch's most famous pieces of advice is to buy what you know. Lynch believed that the best way to identify undervalued companies was to stick to industries and products that you are familiar with and understand. This doesn't mean that you should only invest in the companies that you personally use or consume, but rather that you should have a strong understanding of the industry and its trends. By doing this, you'll be able to identify potential opportunities and understand the drivers of a company's performance. For example, Lynch was a big fan of retail and consumer goods companies, and he was known to spend hours in malls and stores observing customers and studying product trends. This helped him identify companies like Staples and The Gap that were poised for growth, long before they became household names. Number 2. Look for Tenbaggers. Another key aspect of Lynch's investment philosophy was his focus on finding Tenbaggers stocks that could return 10 times the original investment. Lynch believed that a portfolio filled with Tenbaggers could provide outsized returns, even if a few of the investments didn't pan out. He also believed that it was more important to find a few great stocks than to diversify a portfolio with a lot of mediocre ones. To find Tenbaggers, Lynch would look for companies that had strong growth potential and a durable competitive advantage, such as a strong brand or a proprietary technology. He would also look for companies that were undervalued by the market and had a low price-to-earnings ratio. Number 3. Understand the psychology of the market. Another important aspect of Lynch's investment approach was his understanding of the psychology of the market. Lynch believed that the stock market was often driven by emotions, and that investors could take advantage of this by buying stocks when they were out of favor and selling them when they were in favor. To do this, Lynch would look for stocks that were being overlooked or undervalued by the market, and would take a contrarian stance by buying them when they were out of favor. He would then hold on to these stocks for the long term, and wait for the market to recognize their true value. Number 4. Keep a long-term perspective. Lynch believed that the key to successful investing was to have a long-term perspective. He believed that the stock market was a long-term game, and that investors should focus on the fundamentals of a company rather than short-term fluctuations in the market. To achieve this, Lynch would conduct extensive research on individual companies and industries, and would only invest in companies that had a strong track record of growth and a durable competitive advantage. He would also hold on to these stocks for the long term, rather than trying to time the market or make quick profits. In his book One Up on Wall Street, Lynch said, "I can't remember ever once having seen the name of a market timer on Forbes' annual list of the richest people in the world. If it were truly possible to predict corrections, you'd think somebody would have made billions by doing it." Number 5. Take advantage of market inefficiencies. Lynch believed that the stock market is often inefficient and that there are many undervalued companies that are overlooked by the market. To identify these opportunities, Lynch would study the financial statements of companies, compare them to their peers, and look for companies that were trading at a discount to their intrinsic value. He would also pay attention to market trends and events that could cause temporary dips in stock prices, but had the potential to recover in the long term. Lynch was known to invest in companies that were temporarily out of favor due to a short-term setback such as a product recall or a natural disaster. He believed that these types of events were often overblown by the market and that the underlying business was still strong. By buying these stocks when they were out of favor, he was able to take advantage of market inefficiencies and earn higher returns over the long term. Number 6. Don't try to time the market. Lynch advised investors not to try to time the market and instead focus on the long-term potential of a company. He believed that it's impossible to consistently predict market fluctuations and it's better to invest in companies with strong fundamentals and hold on to them for the long term. To apply this principle, investors should conduct extensive research on the companies they are interested in and understand the business inside out. This will give a better idea of how the company will perform in the long run. Also, investors should avoid making short-term decisions based on market fluctuations and instead, focus on the fundamentals of the company. Number 7. Be patient. Patience is key when it comes to investing. Lynch believed in the power of compounding and the fact that it takes time for a good company to grow and for the market to recognize its value. He advised investors to hold on to their investments and not to sell them prematurely. By being patient and holding on to their investments for the long term, investors can take advantage of the power of compounding and potentially earn higher returns over time. It's important to remember that investing is a long-term game and it's important not to make hasty decisions based on short-term market fluctuations. Number 8. Continuous education and learning. Finally, Lynch believed that investing is a lifelong learning process and that it's essential to continuously educate yourself about the markets and the companies you're investing in. To stay informed, he would read annual reports, industry publications, and books about successful investing, and kept himself updated on companies' earnings, news, and developments, as well as new market trends. Lynch would spend hours researching individual companies, studying their financial statements, and talking to management. He would also attend industry conferences and visit the company's facilities to get a better understanding of the business. By continuously educating himself, Lynch was able to stay ahead of the curve and make better investment decisions. In conclusion, Peter Lynch's investment philosophy may have been developed decades ago, but it's still relevant today. His approach emphasizes the importance of understanding individual companies and industries, and of looking for undervalued companies with strong growth potential. His advice to buy what you know, focus on finding tenbaggers and maintaining a long-term perspective are timeless wisdom that can help investors achieve success in any market. As Lynch himself said, the key to making money in stocks is not to get scared out of them. By following his strategies and insights, you can become a more successful and disciplined investor, just like the Wall Street legend himself. Thanks for watching. We hope you enjoyed learning about the wisdom of Peter Lynch and the strategies that made him one of the greatest investors of all time. Don't forget to subscribe to our channel for more videos on investing and personal finance. We'll be sharing more insights and strategies from some of the world's most successful investors. With the knowledge and tools you've gained from this video, you'll be well on your way to achieving financial success. Thanks for watching, and we'll see you in the next video.